Okay, so the next one is solvency ratio. This is chapter 2. What is solvency ratio? Solvency ratio is a key metric used to measure an enterprise's ability to meet its debt obligations and is used often by prospective business lenders. The solvency ratio indicates whether a company's cash flow is sufficient to meet its short and long-term liabilities. The lower a company's solvency ratio, the greater the probability that it will default on its debt obligations. So if lower yung solvency ratio na makompute mo, this means na may malaking posibilidad na may default sa debt obligations mo. So these are the commonly used solvency ratios: debt ratio, equity ratio, debt to equity ratio, and times interest earned.
Debt ratio, assets are always equal to liabilities in owner's equity. This simple accounting equation is depicted in the balance sheet of the business. Its formula appears below. Assets is equivalent to liabilities plus owner's equity. In the business, there are always two claims against assets. These claims are the claims of the creditors and the form of the liabilities, and the claim of the owner or the owner itself in the form of owner's equity. The debt ratio is basically measures the percentage or proportion of fund that is provided by the creditor. The formula used to compute the debt ratio is equivalent to the total liabilities all over the total assets. By applying the formula, we can have debt ratio is equivalent to 1,090,100 pesos all over the total asset of 1,395,000 pesos is equivalent to 0.781 s to 1 or 78.14%. The debt ratio of Angle Trading for the year ended appears to be high. It means that 0.7874 pesos has been provided by the creditor for every 1 peso of the business, or 78% of the total investment comes from the creditor. Next reporter.
Equity ratio. The equity ratio determines the level of investment provided by the owner. Its formula is equity ratio equals to total owner's equity divided by the total assets. Equity ratio uses a company's total assets and total equity to help indicates how leveraged the company is, how effectively they fund assets requirements without using debt. Again, the equity ratio determines the level of investment provided by the owner. And the formula is very simple. You just compute the total equity divided by the total asset. The example of using equity ratio formula is equity ratio equals to 304,900 divided by 1,395,000, which is the total assets, equals to 0.21 something or 21.86%. It means the total resources of the business is always equal to 100%. If the creditor has provided 78.14%, the owner or the owners then has or have provided 21.86, which the computation applied shows a low equity ratio is not favorable to business.
Okay, Debt to equity ratio. The debt to equity ratio measures the percentage or proportion of debt and equity in the capital structure of the business. It is computed as follows. This is the formula as you can see on the screen. Debt to equity ratio is equal. You must take note of the total liabilities all over the total equity of your business. So by applying the formula, for example, this is only an example. 1,090,100. This is the total liabilities of Angle Trading all over its total equity, which is 304,900. So the answer is 3.57:1. This means that for every 1 pesos invested by the owner to the business, the creditor provides 3.57 pesos. So there is a high debt to ratio. A high debt to equity ratio is not favorable to the business. So a low debt to equity ratio. This indicates that a lower amount of financing by debt via lenders versus funding through equity via shareholders. Otherwise, a higher ratio indicates that the company is getting more of its financing by borrowing money. So, if mas marami kang ginaborrow na money, this subjects the company to a potential risk if debt levels are too high. Maaaring mabankrupt yung company mo kasi marami kang debt obligations. Let's simply put, the more of a company's operations rely on borrowed money, the greater the risk of bankruptcy if the business hits hard times, because hard times are unavoidable in a business venture. This is because minimum payments on loans must still be paid even if a company has not profited enough to meet its obligations. For a highly leveraged company, on the meanwhile, sustained earnings declines could lead to financial distress or bankruptcy. Next, we have the times interest earned. The times interest earned ratio is a measure of a company's ability to meet its debt obligations based on its current income. And we have to use this formula as you can see on the screen. TIE, income before interest and taxes, all over the interest expense. So you must take note of the income before yung final income mo talaga na hindi nabawasan na any interest or any taxes, all over the interest expense. Interest expense means kung magkano yung magagasto mo or sa pagkuha or magkano yung magagasto mo sa interest na gagamitin na expend mo whenever you make a debt on a specific corporation. So you have to use the formula. The TIE of Angle Trading is computed as 72,000 pesos. This is the final income, the official income without any taxes and so on. All over the expenses for its debts, which is 5,000 pesos, is equal to 14.4 times. What is 14.4 times? The result is a number that shows how many times a company could cover its interest charges with its pre-tax earnings. This type of formula, TIE, is also referred to as the interest coverage ratio. So that's all for our report. I hope you've learned something and we've finally come to an end. Thank you everyone and God bless.